Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsor, Wealthsimple, one of the leading online investment platforms globally. Now, Wealthsimple manages over £3 billion for more than 200,000 customers. Wealthsimple prides itself on providing access to smart, simple investing without the high fees and account minimums usually associated with traditional investment management. In fact, you can open a stocks and shares ISA, a SIP or a junior ISA with as little as £1, which is far lower than any of its peers, and every client has access to unlimited human advice from a qualified investment advisor. Now, Wealthsimple also provides ethical investing options and produces an online magazine in an attempt to demystify the world of money. Money to the Masses podcast listeners can get their first £10,000 with Wealthsimple managed free for a year if they sign up at wealthsimple.com/money to the masses. You can also check our full review of Wealthsimple online at moneytothemasses.com.
Hello and welcome to episode 272 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How you doing?
I'm good, Andy. Although we're still in lockdown, there was a bit of a sort of ray of sunshine this week because we are still trying to give out Money to the Masses mugs. So if you've done anything mug worthy, then do get in touch, because although we're not able to send them, we are promising to send them once we are out of this sort of lockdown period and we can get to the post office. But we got a mugshot from somebody who lives in Switzerland, funny enough, and it's an amazing picture. Go and look at our social media. I can't actually remember the mountain that's in the background. He did mention it, but it's impressive. So that was quite nice. So if you want to get a Money to the Masses mug and potentially if you want to get a Money to the Masses mug and cheer us all up with pictures of yourself, a mugshot doesn't have to be somewhere as exciting as a mountain in Switzerland, it can just be your back garden, then please do so. Do get in touch. Email us, usually email address damien@moneytothemasses.com. And leading on from that, Andy, leave a review. I mean, that is probably the easiest way to secure a mug, often, or more often than not, I should say. If you leave a good review, then we often feel pretty generous when it comes to the Money to the Masses mugs, don't we?
Yeah, exactly that. So I've picked out 3 people who have left a review this week that I'm going to read out on this week's podcast. As Damien said, get your review in, claim your review and claim your Money to the Masses mug. So this is what Colomac has said this week. Great podcast, easy to understand. I'm new to investment markets and this has been an excellent guide for me. 5 stars. Pragmatic67 has said, been listening to Damien and Andy for a couple of years now. Great financial advice, market appraisals and methods and tools for saving money. Previous advice has helped me stay calm through these turbulent last few months. And finally, Jeff McQueen, a glowing review here, another 5-star one. Damien and Andy bring the whole financial world to life in an amusing and interesting way. During these tough times, these two give one assurance, the best and the nicest. My only podcast that I listen to. So thanks ever so much, Jeff McQueen. You could get your review read out next week if you pop along and give us one of those lovely 5-star reviews. Okay, so I suppose that moves us on nicely to what we're going to be talking about this week. What have we got lined up on this week's show?
Right, the first piece is going to be an investment piece, and I'm going to be talking about sectors. And what I want people to do is get their app on their phone ready, their investment app, their stock app. And I'm going to go through a list of ETFs that they should plug in and just track, just to watch, to give them some insight into what's going on within markets. So I'll go through that and it will give them insight into their own portfolios as well. So that would be interesting. Moving on from that, I'm a fan of analogies and real life examples to help explain something financial. And today's analogy or piece of research really is based around goalkeepers and what they can teach you about the investment process and what you more than likely shouldn't be doing. And finally, I'm going to come on to the idea of negative interest rates. It's something that has hit the headlines in the UK, the possibility that we may have negative interest rates. So the Bank of England could set the base rate as a negative number. What does that even mean if we ever get to that stage for investors, for people who don't invest, so for people who save or who have mortgages? And it's just really the concept. Why would they even consider it? So the three pieces there, Andy. So I will kick straight on with the investment piece, shall I?
Absolutely. And I'm looking forward to it, Damien, because I've downloaded an investment app myself and I'm going to be following along with you. So over to you.
Yeah, so I mean, for people out there who have, say, an Apple phone, it doesn't really matter what type of phone you have. In the past, I've gone through an array of indices that I look at. So, for example, the FTSE 100. So the iPhone has a default stock app that you can't get rid of. It's there. Most people don't use it. So even if you're not into investing, it's useful to actually have a use for the app, to play around with it, to actually learn something. So in the past, I can't remember which podcast it was, I should have checked, but I listed some of my favorite indices that I look at in the morning. And the reason I do it is not because I'm obsessed with the market, although that's what I do fundamentally, my day job, an 80-20 investor, but it's because you can get a quick insight into the narrative that's driving markets rather than having to read a lot of stuff in the press, or it can help you look at what to read, if that makes any sense. So it gives you a hint as to what the story might be. Could it be Donald Trump is gone off on one in the trade war? But I want to take that on a bit further. And at the moment, if you look at markets, we can look at the S&P 500, for example, and that will more likely not be in your stock app. And the S&P 500 is the US stock market. So I will often focus on that. Now, I know we're in the UK, but the American stock market has the biggest influence on global markets and global indices. So if you see an MSCI global index of some kind, then it will have a disproportionate amount of US equity exposure because of the size of the market. And whatever happens in American stock markets has a huge influence on other markets. So what you'll see is if the market in America tumbled one day, then normally it bleeds over into the UK or Asian stock markets in the following day, because obviously there's the time differences. So when you look at what's going on in the US stock market, you can draw parallels across to what's going on elsewhere. And at the moment, if you look at the S&P 500, you will see that it's rebounded quite strongly from its low that was in March. So I think it was the 23rd of March when we hit the sort of recent low. If you go and compare that to the FTSE 100 in your stock app, you will notice that the pattern is very different. It's similar, but it is different. So the rebound initially becomes as aggressive as the rebound in US equities, but then it starts to flatten out and tail off a bit. So if you expand that to like 3 months, so on most apps, you can then expand the time frame from 1 month or 1 day to 3 months. The 3 month period at the moment covers quite nicely the period from the beginning of the coronavirus sell-off to today. So actually it's 3 months today, I think it is. It was the 20th of February that it kind of collapsed. And you can see it's different in America. There's much more FOMO, the fear of missing out. If you watch our Midweek Markets episodes, you will see that I talk a lot about this FOMO that's happening in America, more so than in the UK or in Asian markets or European markets. It's almost like American investors have become completely detached from reality, whereas we're only just a bit detached from reality and markets are rebounding. But it's quite interesting to look below the surface because the S&P 500 is disproportionately driven by tech stocks. And there's a number of tech stocks, companies like Amazon or Apple, who have a huge influence on the direction of that index. So what they do is they actually mask what's really going on underneath. So in Midweek Markets recently, I talked about how the top 5 stocks in terms of size are having a disproportionate influence, or as disproportionate influence on the overall index as they did in the dot-com bubble. They were the top 5 I'm talking about. There were a different top 5 back then, but the top 5 biggest stocks are having such a big influence, as big as influence as they did at a previous peak when things went a bit wrong. So get your stock app out and go and type in XLK. So XLK. Now, what you'll find is that is an ETF that looks principally at the tech stocks within the S&P 500. And you can see how aggressive that rebound has been for that particular sector. And you can see, therefore, that a lot of it is driving the S&P 500. What we're going to do is look at different sectors within the S&P 500. So I'm going to take another one. If you go and put in XLE and then you find that ETF and you put it into your favorites, if you look at that chart, then it hasn't enjoyed quite the rebound in the same way as some of the tech sector. And that's energy stocks. So those stocks have been hit by the fall in the oil price. And the oil price has rebounded slightly, but you'll see there hasn't been so much euphoria in that sector. And if you go to XLI, that's industrials, then you'll see, again, it's slightly different to what's in the tech sector. There is a communications sector, which is where a lot of the big names in tech also reside. They got moved out of the technology sector into the communications sector. But it's a similar sort of pattern. What you're seeing is individual sectors are behaving very differently. Now, go and have a look at some others. XLU, that is utilities. XLP are consumer staples. You're going to have to probably pause the podcast as I read these things out. XLV, that will give you healthcare. XLRE is real estate. XLY is consumer discretionary. And you don't have to have them all in there, but all of these sectors are behaving differently at the moment. And what we're seeing is this divergence where we're getting the big winners, which are some of the tech sectors, versus some of the losers, which are like XLF is the financial sector. And usually what you would want to see in a market rally that's sustainable is all of the sectors start to play their part rather than just being one sector that starts to drag everything up. So you want to see the heavy lifting shared amongst all the other sectors. But what is interesting is different sectors can behave very differently in different economic environments as well. So right now, historically, utilities, consumer staples, healthcare and real estate. So if you have those indices on your app, they should be weathering the storm better than, say, some cyclical sectors, which are energy, the XLE, industrials, XLI, and consumer discretionary, which is XLY. Now, none of this is a given. It isn't a certainty. At the beginning of the sell-off, it did hold true. It certainly did. I mean, real estate and utilities did very well at the beginning part of the sell-off. Then in March, things started to unravel, even for those defensive sectors. And in fact, they've started to lag. And what we've got is everybody's starting to believe we're in a new world now, a new world that is very different to pre-coronavirus, where online retailers are becoming more and more dominant, and the old style or the old way of retail is going to struggle. So you're starting to see the older industries being unloved, people selling out them because they're struggling with the lockdown, whereas things like Amazon are flying. Amazon hit a new high this week. Facebook hit a new high as well, evidently, because they started to, they announced a new idea that they're launching where they enable people to have shops. So businesses could launch shops, people can. Think of it their way of taking on eBay and Amazon. So what you start to see is if you look at these different sectors and how they're performing, you can start to build a narrative. You start to see it. So certain areas that you think should do well, perhaps aren't. Other areas that you expect to do well in the coronavirus world, like tech, are actually doing well. And you can pull it back to your own life. If you sit there and think, what am I doing as a person? So as an individual, I'm spending more online. I'm spending more on food. So consumer staples, XLP, you'll see that will have done relatively well. You'll see things like, because obviously that includes things like products, not just food, but things like cleaning products. Healthcare has done well because obviously we're now in a world that's focused on healthcare very much so, and trying to find a cure for a virus. So these sectors are doing quite well. And it's just interesting to see if you can find the story. That doesn't mean that the story is going to be, that narrative is going to continue, but that is the narrative at the moment. And what we would normally see, like I said, is you want to see some other sectors that aren't doing very well, like financial, start to pick up. And if we see that, then you might start to think, actually, we might now break even higher, the next leg higher on this rally, because the other unloved sectors are now offering value and people are going to start piling into them. So the message of this part of the podcast is don't just look at the sector level for anything. Look beneath it. What's going on below the surface? Where are the divergences? Where are there sectors that are doing really well and ones that aren't? Why might that be? And you could also ponder what might do well in the future if the economy starts to pick up. So as I mentioned, the ones that should be doing well in an environment like this, a recessionary environment, which was the utilities, consumer staples, those sorts of things should be doing relatively well. If we move on to the next phase of the economic cycle, let's say we move into a phase of what they call stagflation, where you have high inflation and high unemployment. Well, we've got the high unemployment pretty much in the bag. And although inflation is tumbling at the moment, people are worried that with all this money printing, there may be inflation will spiral, because in theory, if you print lots and lots and lots and lots of money, then there's more money washing around the system for the same fixed number of assets. Therefore, more of that money will be required to buy that fixed number of assets. I mean, we didn't see that after the financial crisis. We had lots of money printing and we didn't see a spike in inflation, hyperinflation, they call it. Maybe we will do going forward. But if we had a period like that, then you might start to see utilities do well, real estate would do well, energy would do well, and tech would do well. I'm basing that on history. In periods of time, those sectors should do well. And so when you look at the individual sectors and you start to notice particular groups, like I've mentioned, start to perform well together, start to diverge, it could be a sign that the market is now thinking or pricing in the economic environment we are heading into, if that makes sense. So there could be a shift. It doesn't mean the market is correct or will be correct, but it could show you the narrative that they think that's where we're headed. And don't forget, markets sort of forward price, they discount. So they're planning on a world 6 months from now. And another example is if the economy finally goes gangbusters and we start flying and we start boom time again, then the sort of sectors that will do well are industrials, consumer discretionary, the things that you can go and buy in the shops that you don't need. Those are the sorts of sectors that you would start to see doing well in that environment. So it is interesting. So the message is, if you follow these sectors, just keep an eye on and watch them. So when you see the market is up 1.5% on a given day, you will see that some sectors will be in the red, they'll be negative. And that starts to tell you what people are suddenly betting on. And it can swing quite rapidly from day to day. So you don't want to pay too much attention, but you can start to see the underlying trends that are going on, what people are therefore pricing in. And it means as well that you can see breadth, you can see the narrative, but also if you start to look at funds in your portfolio, you can then start to understand why a fund in your portfolio is doing really well or why it's doing particularly badly. Or even if you can't see the sectors, because lots of them will tell you the sector split on the fact sheet. I talked about 2 weeks ago how to read a fact sheet. You should be able to draw parallels from the information you're seeing, and there may be a fund that's doing well. Obviously, you've got to take account geographical differences in currency if you have a fund that's in the UK. But even though you're looking at the American sectors, you can find similar sectors in the UK, but the parallels can be drawn across because at the moment the pandemic is a global thing. So use it to get portfolio insights. Don't necessarily use it to pick an individual fund, but you can see sectors that are doing well. Don't just obsess about the higher indices. Look for those divergences and mainly use it just to try and educate yourself about economics, about how different assets work and different areas of the economy work, ones that suffer. And then you can reflect that back onto the news that you see in the UK. When you start to see things like airlines doing badly and etc., you can start to see that in the stock prices as well and the performance of individual sectors. So don't get bogged down on it, but it will take your investment understanding to another level if you start to look at the slight nuances of what's going on in a portfolio. Even if you have a tracker, so you may have a tracker on the S&P 500, you can start to understand why it's moving or why it's struggling to get any higher. And you can relay that to what you're reading in the international press.
That's really interesting stuff. And like I said before we started this piece, I've been tracking all these things on my stock app as you've been talking. I can see that overall the market's down by about 0.5%, but then there's variances on the different things. I can see the tech sector, I can see utilities, and we're looking at some are down 1%, some are 0.3%, but overall it's sort of 0.5%. It's interesting.
That's why you can have a fund in your portfolio when you look at it and the market hasn't necessarily crashed, because it could be in a sector that's held up. So yeah, utilities today, as you've mentioned it, Andy, are holding up better than tech. And that's partly because we've had a great rally in tech and tech has become quite extended. The prices we've seen over the last 2 weeks, it's what they would call almost overbought and it's due a pullback. The problem is that it forms quite a significant part of the indices. So once it's pulled back 1% on a day, it drags down the wider index down to about 0.5, 0.6. Yet something like utilities, which has had a bit of a lackluster performance of late, bit more defensive, is only down about 0.4%. So you can see the differences. So again, not to labour the point, but if you look at your funds in your portfolio, you could look at different funds in the same sector and see how they complement each other, because you could find you're just really making a bet on tech and you've not even realised it. And you'll probably start to notice that if you start looking at tech is flying, it's the only sector in green, but it's pulling the index up, and your particular fund might be flying. And you start realising, do you know what? I'm overexposed to technology here, and I had never realised it. And so it's quite a good early warning sign that you might want to diversify as well. But anyway, Andy, we'll move on to the next piece.
Yeah, I'm looking forward to analogies. Somehow you're going to weave in goalkeepers and how that sort of links back to finances. Go.
Well, it's not actually my analogy, this one. As we're in lockdown, I'm trying to read a lot more around finance stuff. I spend so much time reading contemporary stuff. It's always quite nice to read other people's view on different things like investing. And one of the books that I'm picked up that's in a pile that I have is one by James Montier. I've mentioned it once before, actually, The Little Book of Behavioural Investing. And I was flicking through it, and there's a really nice analogy in there. And it's actually a piece of research, really, about how we can be our own worst enemy when it comes to investing. And I just wanted to bring it out because there's quite a good lesson in there. And he talks about goalkeepers in football, and in particular, penalty kicks. So in football, the average game has 2.5 goals. If you look apparently across the averages, this is according to the research that he quotes in his book. And penalties are scored 80% of the time. And so that just emphasizes the importance of a penalty, because the success rate has a huge influence on the potential outcome of a football match. Now, they did some analysis across some of the top flight and championship, and they looked at 311 penalties. And I mean, perhaps they could have gone for a bit more, but 311 is a decent enough number. And when they analysed the penalties that were taken, they worked out that about a third of the penalties went down the left-hand side, so it got to the goalkeeper's left, a third went down the middle, and about a third went to the goalkeeper's right. But when they looked at the goalkeeper's movements, they worked out that 94% of the time the goalkeeper dived. And that means either to his left or her left or to their right. And only 6% of the time did they stand still in the middle. And of course, if you think about the numbers I mentioned before, if a third of the penalties are going down the middle and you're actually only spending 6% of the time in that section, then you are undermining your own performance. Basically, by doing something, as in diving, you are weakening your performance. And in fact, if goalkeepers stayed in the middle, did nothing, they would save the penalty 60% of the time. That was the average that they worked out. So the message in this piece of research was that goalkeepers, not that goalkeepers should stand still, but why are they diving? And perhaps they shouldn't. And when they asked the goalkeepers why they dived, I mean, you can imagine, Andy, what the answer was. Why? I mean, if you were a goalkeeper, why would you dive?
Yeah, I would definitely dive one way or the other, because I'm being paid to do a job, and at least by doing something, you know, they're expecting to score, right? So if I dive one way and I don't get it, then I think, oh, well, at least I tried, kind of thing. I felt like I needed to do it.
Yeah, you've hit the nail on the head, Andy. That was what the goalkeepers said, that they felt that they needed to do something, because standing still and watching the ball go past you, people would think, well, why didn't you dive? But at least you always hear on the commentators when they see a goalkeeper, oh, he chose the wrong way. Fundamentally, he dived and he shouldn't have done. So the lesson from the research really is that by goalkeepers standing still, by doing nothing, then they could increase their performance. And so taking that to the world of investing, sometimes just doing nothing is the best strategy. So if you think about, we've talked about it a lot on the podcast, and somebody even mentioned it in the review that you read earlier about how they felt better after listening to this podcast through this recent period, that often doing nothing in a sell-off is the best thing to do in the long term. If you're a long-term investor, there is no compulsion to do anything. You're better off following a process rather than just making a decision because you feel like you should do something because the market is falling. And so that's the message, that often by doing nothing, you actually don't undermine your performance. Doing something means that you're making a choice could actually make you worse off. So taking the lesson a little bit further, it didn't actually guarantee the guy would save a penalty when they took it. It just meant by following a process of saying, I'm going to stay in the middle of a third of the time and mixing it up, then it was actually pretty much down to the law of averages that they would save a penalty. So it's a process. It can increase your odds. And saying that on in an investment world, having a process is important, because whatever that process is, you don't become emotional, just do something because it makes you feel better. So that could be you review over a particular period of time at a particular date. Maybe it's once a year. Go back and listen to the previous podcast when I've talked about these processes and what you could do, but don't do things just because they make you feel better.
Okay, and that moves us on to the last piece, and we're going to be talking about interest rates and negative interest rates. Will it happen? What does it mean? How does it affect people? Damien?
Yes, negative interest rates are interesting because there's been a lot of talk about the possibility in the UK. And the governor of the Bank of England is now a guy called Andrew Bailey. And previously it was Mark Carney. And he left the position earlier on in the year. And he pretty much said that the Bank of England wouldn't go negative on interest rates. At the moment, the base rate is 0.1%. So that interest rate has a lot of influence over interest rates in the economy, that be it from mortgage rates to savings rates. And the idea is that in order to support the economy, to promote some sort of economic growth, they start to cut the interest rate to stop the economy stalling. Like the analogy I've said before about going down the gears in the car, you go down the gears to stop the engine stalling. It's the same thing with the economy. So they start to move down the gears. Of course, the idea of going negative is a very strange concept because in simple terms, if there was a negative interest rate, that would kind of mean that the Bank of England, we're talking about institutions here, they would effectively have to pay to have the Bank of England have money for them, if that makes sense. The idea of a negative interest rate just baffles. It's kind of mind-blowing that we've even got to here. The European Central Bank has already done this. This has happened ages ago. This is old news for Europe. And Andrew Bailey suggested that we shouldn't rule out the idea that we may have a negative interest rate in the UK. So our base rate might go below zero. And that isn't that crazy because this week, the UK actually issued bonds to the tune of 3.8 billion, so gilts, for 3 years with a yield of minus 0.003%. What that means is a gilt is a loan. So it's a loan to the UK government. And what normally happens is, like any loan, you loan somebody money and you get paid basically a coupon, an interest payment, and then you get your money back at the end. Well, with the yield now going negative, that means effectively the people are paying the UK to lend it money. That is a crazy world that we're in. And again, this has happened around the world already. So the idea of negative rates, we've got to get used to the concept. But then what does it mean for people in the UK? If you're a saver, you're not going to get your bank give you a negative savings rate because then you'd have to pay to put your money there. What it means is you're going to get absolutely nothing probably at some point. For mortgage rates, they tend to have some kind of collar whereby even if they track the base rate, they won't go below a certain level. So you're not going to get to the point, very unlikely. I think there has been a strange case from the sort of eons of time where somebody had a mortgage before the financial crisis and all these issues where they did get to a point that a lender was almost paying them to have a mortgage. But you're not going to get to the point where you're being paid to almost have a mortgage. You're not going to have a negative interest rate on your mortgage. So by having a negative interest rate, what the Bank of England is trying to do is encourage banks to lend and us to not save. And the only downside to that is you could get to the point where companies could end up not holding as much cash as they would once have done because they're not getting any money or decent return in the bank. So they would rather go and use that money for other means and get a return. So it could backfire in a way and cause companies to have less money for a rainy day. So I thought we'd touch upon the negative interest rate story. It's something that we'll probably come back to in the future. For consumers, it's largely going to be the same answer as what would happen if we had almost a 0% interest rate at the Bank of England. But it just shows you what a distorted world that we are in at the moment.
Excellent stuff. So we are done. If you want to contact Damien, you can do so in the usual way. It's damien@moneytothemasses.com. You can contact him on Twitter. It's @moneytothemasses with a number 2. We've got the Facebook group. Go to facebook.com/groups/money to the masses to get involved. And don't forget, review the podcast if you can. Do something mug-worthy and you can win yourself one of the coveted Money to the Masses mugs. Damien, we're done, I think.
We are. So until next time.